I think we are in a new bull market.
A 10-year bull run to 2035, driven by demographics, artificial intelligence, and a Fed that markets will ultimately keep in check. There are 3 specific signals behind that call, and the third one tells you exactly what would need to happen to end this bull market. Right now, not one of those warning signs is flashing. Markets have been rattled, tariff chaos, Federal Reserve political pressure, debt levels climbing toward historic highs. It's been enough to shake even the most experienced investors. But here's where it gets interesting, because Tom Lee isn't shaken at all, and his reasons are backed by data that stretches all the way back to 1890. Signal number 1 is the one most people completely ignore: demographics. Tom Lee has built his entire market framework around a single observation, that every major bull market since 1890 has been driven by a generation reaching its peak economic power, and every major bear market has occurred in the gap between generations. It sounds almost too simple, but the data is extraordinary. The 1999 market top. That was the baby boomers hitting their peak. The 1974 crash, the generation before the silent generation running out of steam. Generation X peaked in 2018, and right now, millennials are still climbing. Their peak? Tom Lee puts it at 2035.
Demographics really explains almost every bull market since 1890, actually. So if you followed every generation, the gaps between the generations are really where the bear markets exist, and the bull market tops coincide with the peak of a generation.
Think about what that means structurally. Millennials and Generation Z represent the biggest surge in United States prime age workers in decades. They're entering their highest earning years, they're inheriting wealth from their parents, and that wealth is moving out of bonds and low yield savings accounts, and into equities. Tom Lee sees tens of trillions of dollars in wealth transfer happening over the next 2 decades. The destination for most of that money is the stock market, but there's another layer here that most investors miss. Tom Lee's team doesn't analyse markets from the perspective of experienced fund managers. They actively survey young people, because young people are the ones actually driving economic change. They're the consumers, the early adopters, the disruptors. And right now, they are all in on the digital economy.
Gen X peaked in 2018, and millennials will peak in 2035. So those are like rough waypoints for when actual major tops take place.
That's not a guess. That's a data point 12 years in the making. But here's where it gets uncomfortable. Because signal number 2 isn't about opportunity, it's about risk. The Federal Reserve is under political pressure right now. The administration has made clear it isn't happy with interest rate policy, and when you understand what the Fed actually controls, that pressure becomes genuinely alarming. The Fed doesn't just set interest rates, it sets the temperature of the entire global economy. When it speaks, stock markets move instantly, chief executives change their capital spending plans, governments adjust their borrowing strategies. That's not an exaggeration, it's mechanics. So what happens if that independence gets compromised?
Fed independence is really important because the Fed is the single most powerful entity in the world, right? Because what the Fed says triggers an instant response across all markets and CEOs and policymakers everywhere and even governments. So that being independent is critical.
Tom Lee's answer is that the markets themselves will not allow it to happen. We already saw a version of this play out when tariff announcements rattled global markets earlier this year. The administration pulled back. Markets forced the hand. Tom Lee believes the same dynamic will protect the Fed. No administration wants a market crash, and interfering with Federal Reserve independence would trigger exactly that.
I'm going to lean towards the idea that Fed Chair Powell serves his term. But even if it's just noise now, it is just someone comes across as more not happy with policy, but they're not going to interfere.
So, similar, I guess, that the markets forced the hand after the tariffs a little bit.
Markets as a check on political overreach, signal number 2, and it's more protective than most Nvidia holders realise. Signal number 3 has a 100% historical track record, and it just fired. But before we get there, here's what this means for Nvidia specifically. Tom Lee's structural thesis rests on 2 forces: artificial intelligence and blockchain. He sees these not as trends but as foundational shifts in how the entire economy functions, and he expects the financial sector alone to re-rate from roughly 13% of the S&P 500 all the way to 40%. a near tripling driven by technology embedding itself into every layer of how money moves and gets managed. Nvidia sits at the center of that shift. The company's chips power the artificial intelligence infrastructure that every major institution is now racing to build. Data centers, large language models, autonomous systems, all of it runs on hardware that Nvidia dominates. And as blockchain scales, Nvidia's processing power becomes increasingly critical there too. The sell-off from February to April 2025 shook a lot of Nvidia holders out of their positions. That was painful. But according to Tom Lee's framework, that sell-off was the trigger, not the warning. And that brings us directly to signal number 3. Because this is the one that makes everything else click into place.
Whenever the VIX has been above 60 and closes below 30, 100% of the time, that's been the bottom.
Yes.
That's what you said, right?
Yeah.
And that's true 100% of the time?
Yeah, we never found an instance that it didn't work.
100%. Every single time in market history, when the volatility index spikes above 60 and then closes back below 30, that has been the bottom. Not sometimes, not usually. Every single time. The February to April 2025 sell-off sent volatility through the roof. Nvidia dropped sharply, investors were panicking, but then the volatility index crossed back below 30. And according to Tom Lee's data, that was the signal. Not a maybe. A mechanical, historically verified bottom signal. If you sold during that sell-off, signal number 3 just told you the bottom is already in. Now here's the most important question. If Tom Lee is right about all of this, what would actually end it? What are the warning signs that the bull market is genuinely over? He says there are 2 things. First, a policy shock. The Fed pulling liquidity out of the system so aggressively that companies can no longer outgrow the cost of money. That happened in 2022. But that kind of shock doesn't arrive quietly. Both investors and the Fed itself see it coming in the data well in advance.
The top is going to have 2 sources of the negative catalyst. The first is a policy shock. So at the top, the Fed could pull the rug. That's sorry, not the right term. The Fed could end liquidity, and that would create a pullback. I mean, even a bear market.
The second warning sign is excess speculation. Think about what 1999 felt like. Money was so freely available that people were demanding you get on board with every new idea, no matter how absurd. The fear of missing out drowned out every rational argument. Is that happening now? Tom Lee meets with over 400 hedge fund clients, and right now, meeting after meeting, the response is the same. They sit through his entire presentation, they see the demographics data, they look at the structural case for artificial intelligence and blockchain, and then they say, Tom, this all sounds fine, but I don't believe you because you're always bullish.
There's so many skeptics. On our clients, when we have 400 hedge fund clients, meeting after meeting, and this is interesting, someone inevitably always says, Tom, everything you're saying is fine, but I don't believe you because you're always just bullish. And so they're immediately skeptical of everything we just said.
That skepticism is not a top. That is the bull market. When 400 of the most sophisticated investors in the world still don't fully believe the bull case, when margin debt is nowhere near record territory, when excess speculation is completely absent, you are not at the top. You are in the middle of the climb. 3 signals. Demographics pointing to 2035. A Fed that markets will not allow to be compromised. And a volatility bottom signal with a 100% historical track record that just fired. The checklist of things that actually end bull markets, policy shock, excess speculation, margin debt extremes, none of them are flashing.
When you're investing, you should really think of it more as you're buying companies, not just buying the stock market, because then you'll have a lot more conviction about what you own.